Well, today was a doozy. My name is Hamilton. I'm here at the Trading Initiative. Over the next 5 minutes, let's talk about today's moves and what it could potentially be setting us up for tomorrow's FOMC announcement. First things first, when the market opened up, it actually didn't look that bad. Obviously, we opened up slightly down. Market internals were slightly down, but the Mag 7 stocks were actually slight green off of the open, and so there really wasn't a whole lot of indication that this was going to end up being as big of a down day as it was. Now, Janet Yellen started talking midway through the morning session, and she started saying some crazy stuff. And by crazy stuff, I'm talking some real life stuff that maybe she should have been talking about for the last 3 years. But she's finally starting to admit the fact that there might be a U.S. debt problem. There might be a government spending problem, that maybe the housing market is unsustainable, particularly for first-time home owners and buyers. Things like this, maybe things that inflation, things that probably have been a problem and should have been talked about openly for the last 3 years that she's been gaslighting a majority of Americans on. She finally came around. So interesting timing here prior to a pretty important FOMC decision tomorrow to start all of a sudden flipping back to, hey, I think actually we have an issue. And whether or not the market sold off entirely because of Yellen's comments or not, it happened around the time Yellen started talking. So we're going to go ahead and pretend that maybe it had a little bit to do with it. But of course, we're not trading based off of what Janet Yellen or Jerome Powell or what anybody says. Fiscal and monetary policy are fun topics to argue over, specifically over beers. But inside of TTI, the only thing we care about is price, because as soon as publicly available information comes out, the market starts to immediately discount that information into price, and we can see it immediately start to form, right? And so today ended up being a pretty big down day. As a matter of fact, we closed at the lows, and after hours, we continued to press down into new lows. Completely different from what we've been talking about over the last week. And it's part of the reason why, as we were going through this internal and public conversation that I'm now having on YouTube every single day, is it time to start buying these positions? And we started to say, yeah, at the end of last week, we were opening up some new positions. But I think it's important to understand that these were feeler positions. So not full positions in terms of position sizing. They're not full 1R. We were not trying to full port. We didn't want to call the absolute bottom, but what we didn't want to do was miss a potential gap up off of an FOMC decision that, who knows, could still happen, probably will not. But the worst case scenario was, in fact, not being in any positions to take advantage of that gap up, because then we were going to play the incredibly difficult catch-up trade. In the event that that does happen, we still have some small exposure in newer positions. We did not get stopped out of many positions today, at least new ones. We did get stopped out of some old positions, which we'll talk through in a second. But realistically, if we do gap down and continue into new lows, the entire idea that we've had inside of TTI is that we want to buy near the 200-day moving average. I mean, that's been our goal since the middle of January, when we started expecting a pullback that didn't actually start pulling back until midway through March or beginning of April. We thought it was going to happen in February, and it didn't. We were still able to capture a lot of this price movement to the upside through February, but we did not expect that to happen. So it's important to understand that we're trading based off of price and not gut. We're not trying to predict the future here, and occasionally we're going to get caught in some reversals like we did today. Those new positions that we opened up over the last 3 or 4 sessions are now, most of them are minor red, which sucks because we had such a good head start. For example, Apple, we had such a great head start coming into today's session. We had contracts up over 50% that are now currently break even. I think they're up 0.089 right now based off of today's pullback, which sucks because we gave up about a 3 or a 4 session ramp up plus a gap and go type of situation on Friday. We had a big head start. We wanted to take half off prior to Thursday's ER. Doesn't look like we're going to have that opportunity. Another position that we opened up recently was CAR 2 or 3 sessions ago. We bought the breakout in towards this all-time high area above 60. We're now currently flat on the contracts. They were up 30 or 40% at market open today. So once again, these newer contracts that we've opened up, they're not necessarily down huge. Unfortunately, they're just not really working the way that we wanted them to work heading into the FOMC announcement. So whether or not we're going to stop out of those tomorrow, I have no idea what we're gonna do yet. It matters where we open up tomorrow, how the market responds off the open. Generally, FOMC event days, we have very low volatility, very low volume until the 2 p.m. decision comes out. We obviously have a very big volume of volatility spike, and then we have another volume volatility event at 2:30 when Jay Powell starts speaking. So it's important to understand what the market does off of those 2 pivot points, more so than what it does tomorrow morning. But of course, if you're inside of TTI or have taken any of these trades with us that have gone out in the newsletter, we want to take this one day at a time. The CARR, the Apple trade that we just recently opened up, Wish it would have worked better, but we're not holding these big losers right now. Two positions that we got stopped out of today, though. Valero, this was a winning trade that we took profit off of, and it was completely free. So this was the last portion of our contracts. We ended up closing, or should have closed today. If you didn't, this is your sign to potentially start looking at closing some energy-related stuff. And then MPC as well, a massive 10%-ish down day on a sector leader after a double beat in earnings. Pretty nasty stuff, but once again, this was a huge win for us. We were able to chip profits off on the way up, so this was a relatively small position on the way back down. Still profitable, very profitable position. I don't want to undercut or underplay this. This was a very profitable position. The last portion of the position, obviously, we got stopped out of today. But talking about energy in general, check this out. The worst performing sector today was energy. It was down 2.98%. I thought it was going to hit 3%. This is a particularly bad day for the energy sector. Now, a question that I asked inside of TTI, and I think it's important to ask you guys as well, this was a 2-year or a 3-year high breakout into a new decade high, right? Last time we were up here was way back in 2014. Is this a fake breakout? Are we going to fall back within the same range? And is it time to close the energy positions that we still have on the books? Or is this just, if we go to the weekly, a very normal all-time high type of situation where you get the break, you're going to pull back in towards previous resistance area, and you'd expect some support to form and then a bounce? These are questions that I don't know the answer of. You're never going to know the exact answer until it already happens. I would expect this to bounce here. We've obviously started to trim some of the positions that we opened up that were up huge, but we still have some energy exposure on the books. And it was a particularly brutal day to hold those energy positions, particularly those that were unable to pull off any risk prior. So names that maybe we were unable to close half at 100%. PBF is a good example of that. A trade that was doing really well, but unfortunately today got hit and is now just a straight up down. So we were unable to sell half of this at 100%. It's just a down trade now at this point. What are we going to do with it? I don't know what the answer is yet. But anyway, moving forward, if we look at like the Qs and stuff, I have no idea where we're going to be a week from now. I didn't know where we were going to be, last week. I didn't know where we were going to open up or anything. As a matter of fact, once again, we're sitting here waiting for this retest at the 200-day moving average. But we're going to take what the market gives us. We're going to continue to throw feelers out there unless it doesn't make sense. And I think that's the last thing I want to talk about is the fact that the RSI is now, obviously, we want to be long above the 50 RSI, or at least that's one of the three things that we look for when we're looking to buy the dip here post-market correction, is we want the RSI to be constructive, and that's on the north side of the 50. It shows that bulls have more control than the bears, but particularly when we're range-bound above the 50 and below the 100. That's called a bullish momentum regime. And right now, as of yesterday, we were just cracking up and over the 50. Lo and behold, the very next day, we have a pretty big down day today. The Qs are down 1.89%, and the RSI is all the way back to 43. SPY is all the way back down towards 43, and IWM, which got hit worse than all of them at 2.03, is down to 42.98. So this is the question that we have to ask ourselves. If we're a momentum-based trading strategy system community, which we are, is the momentum firmly in the bull camp? Is the momentum firmly in the bear camp? Or is it somewhere in the middle? As of right now, you got to give, from a momentum standpoint, edge to the bears here. The RSI is rejecting off of the 50. All three major indexes are showing the exact same move. Anything could happen tomorrow, but you got to give edge to the bears here. So if you're thinking about, is this the time to be opening new positions, at least with our type of time frame, anywhere between 45 to 180 days out, I'm not entirely sure. The last thing I'm actually going to go through here is the Dixie. This has been the most important chart for the last 2.5+ years. We talk about it all the time on the channel. We talk about it all the time in the premium newsletter. The Dixie is the most important chart in the market. If the dollar is up and over the 106.5 area, I would expect more harm than good in the indexes. If we break above 107, which we are very close and absolutely could happen tomorrow if the FOMC interest rate decision comes out and the market doesn't like it, this is probably what bears want and what bulls have nightmares over. If we break above the 107, I would absolutely hold off on opening new positions. I'm not telling you that you should, but I'm telling you I will hold off on opening new positions until there's some sort of floor, hopefully met somewhere around the 200-day moving average. This is kind of a doomsday scenario for bulls. If you're bears, this is what you want to short into. And if you're opportunists, meaning you're sitting on the sidelines with cash waiting to buy, I would wait to see what happens at the 107 area in the Dixie. It's going to be, I don't know what it's going to be tomorrow, but we're pretty fucking close to the 107 area. So watch out if you're trying to go long into this dip. Guys, my name is Hamilton. I'm here at the Trading Initiative. If you like this type of content, please like and subscribe. I also write a daily email. It's linked below. Highly encourage you to subscribe. I send out a daily scanner with a couple trade ideas almost every single day with those trade ideas, daily scanner every single day, and some market thoughts. It's a nice way to get a different perspective on the market. I scan through a bunch of different stuff. You can unsubscribe at any time. It's completely free. Encourage you to sign up, see what we're about. I'll catch you tomorrow post FOMC.